continue with the presentation. Thank you.
I want to make a note that we have an advisory and forward-looking statements in the back of in the appendix of our presentation, and also note that most of the dollar amounts that I'm going to refer to are Canadian dollars. So Seven Generations Energy, we're a specialized and focused Montney developer. We have a particularly attractive position in the Montney. It's 800 sections, more than 500,000 net acres. In the south part of the Montney, which is deep, overpressured, actually a very good quality rock. Generally, that's a dolomitic siltstone, so it's very fragile, very brittle. It fractures very efficiently. And one great attribute of it is that we have very high liquids yields in this area. So our liquids content tends to be about 58%. In that, about 37% of our total BOE is condensate. So we have become the biggest condensate producer in Canada. We've transitioned our company. We were a very rapid growth company. We grew from about 8,000 BOE per day in 2013 to over 200,000 BOE per day in 2018. We then transitioned the company. We transitioned away from rapid growth to a company that's more focused on maximizing free cash flow and returns to shareholders. And so that was a transition we made 2 years ago. I think before that was cool. We began thinking about that as the best strategy for our company. So we're in both a geologically advantaged position, as I said, but also at a geographically advantaged position. Our position is just off of Highway 40, south of Grand Prairie. We have a paved road then through our lands. We build high-quality roads to that paved road and pads that we can work year-round on. So we are not much affected by spring breakup conditions. We can work throughout the year. We also in this area have two transcontinental pipelines, both the Alliance Pipeline and the Trans-Canada Pipeline systems. So we've contracted access to both those pipelines to get our products to premium price markets, and that's allowed our growth to progress. We are about, last year we generated about $1.4 billion of cash flow, and as Manav said, in that we had about $160 million of free cash flow. The first year ever that we've had that free cash flow, and we are in a very good position to have free cash flow this year, even with commodity prices having been tapered off. So we have, I think, a very unique business that's been created, and I'm going to talk a little bit more about it. So first thing is, like our mission is to build a sustainable energy company that serves all stakeholders and delivers compelling returns to our shareholders. We have very good attributes in that we have a good culture in the company, we have best-in-class assets with a deep inventory of drilling opportunities, and we have operational excellence, and that's been getting better and sharper year by year. This is an example of it. This shows the improvements in drilling costs, completion costs, and even operating costs over the last 4 years. And the trend is in the right direction, and I want to say we've been accomplishing these improvements in capital efficiencies and operating cost efficiencies, even while still delivering some of the very best wells in North America. We consistently, in fact, I love the wording of one of the analysts that covers us, we consistently dominate the top well list for condensate and oil wells. And that's important to us. So what's really important is the capital efficiencies. It's both getting the costs down, but also maintaining the productivity of the wells. We've been able to do both. And this shows our focus on the shareholders. So year by year, we've been very focused on improving our funds flow per share, our production per share. Our cumulative share buyback shows there we've been buying back stock since the end of 2018. We've now bought back about 9% of the company, and that's delivering on the right side still adjusted net income per diluted share that's been increasing year by year. The top right chart, I think it's important to mention. So even over the last 2 years, even as I said, we've been focused on free cash flow and focused on optimization. We have still generated per share growth. So we chose to allocate our capital to share buybacks instead of growth, but even as we buy back stock, our per share growth is still, I think, meaningful. This is one of the, I think, most important slides in the deck. In the beginning of, at the early years of our company, we had access to capital. We had very good capital providers that allowed us to invest 3 or 4 times our cash flow to grow the company to the state that it is now. And so That allowed us through time to grow from that 8,000 BOE per day that I mentioned in 2013 to over 200,000 BOE per day. And now, last year, for the first year ever for us, we actually invested less in our capital program than our cash flow, and that's shown on the right side where we had true free cash flow of about $160 million last year. This year we put out a budget with a plan for $50 WTI and about $2.50 gas. Gas is lower than that, WTI is a little bit lower than that, but even with that, because we've been careful about protecting our cash flow and our balance sheet, we've been able to, we still forecast some free cash flow this year. This is another very important slide, shows kind of our changes, our capital program reducing year by year. You can see 2018, our capital program was nearly $1.8 billion, and in that we had about $1.2 billion of sustaining capital. The next year, 2019, last year, our sustaining capital was about $1.1 billion and a $1.23 billion program. And this year we intend to have a total capital program of about $1.1 billion, in which there's $1 billion of sustaining capital. So year by year, 18, 19, 20, we reduced our sustaining capital by about $100 million. And that's a reflection of two things. First one being that our declines moderate year by year. So our declines go down just as because we're not growing right now. The average age of our wells is increasing a little bit year by year. Our declines at the beginning of 2019 were probably about 45%. Beginning of this year, it's about 42%. We think at the end of this year, beginning of next year, it'll be about 39%. And so continuing to go down, that's helping to reduce the amount of sustaining capital needed to stay flat. And as well, our capital efficiencies continue to improve, and that's also helping our sustaining capital to go down. You can conceive that in a few years from now, let's say 2022, 2023, that as our sustaining capital keeps going down, it could be about $800 million in that time frame. At the same time, if we had cash flows like we had last year, $1.4 billion, we would have about $600 million of free cash flow. And in the orange numbers at the bottom, you can see our share count declining. So it's conceivable 2022, 2023, at about 300 million shares. So $600 million of free cash flow on 300 million shares, you're talking about $2 per share of free cash flow, which obviously is a pretty meaningful amount. What we've shown on the right side is the projected cash flows at various WTIs, and you can see, just as I've said, there's opportunity here. A lot of torque for us in terms of increasing our free cash flow with WTI. We as a company we've always been quite focused on the environment and reducing our impact on the environment, reducing our greenhouse gas emissions. We have, to my knowledge, the lowest carbon intensity of any energy company in North America. That's meaningful to us. We've also evolved. We've matured as an organization from the startup days where we were funded by private equity until now, a maturing entity. So we've evolved on the governance side. Last year, 4 of our founding directors, 4 that came with private equity money, didn't stand for re-election. We have new, essentially a completely independent board right now. That's important to us on the governance side. On the social side as well, some of what we've been accomplishing in terms of not just ESG performance, but also how we've been reporting about our ESG performance, is being noticed and recognized by external entities. So we got recently included in the Jansi Social Index. Back to the left side, the CDP, what used to be called the Carbon Disclosure Project, they rated us as the only company in North America with an A- rating, which matters to us. And I think in time that's going to show up in our cost of capital. But our focus on ESG has always been important. We have actually stepped up our reporting of our ESG performance, which is, I think, showing up and will show up. Little detail on our 2020 budget. As I said, this is the second year in a row we're choosing to stay flat. We're choosing, instead of investing in growth, to instead optimize our free cash flow and return capital to shareholders. When we consider the allocation of capital, we believe with our share price where it's at now, it makes more sense to buy back stock than it makes sense to grow. So we're choosing to stay flat. This year, we are more than 80% drilling and completions and tie-in costs in our capital. We do not have significant infrastructure investment like we had last year. Last year, we had well over $100 million in pipeline costs to connect our new Nest 3 area to our core Nest 2 area. The previous year, we finished building our third owned processing plant, and so we had pretty significant capital investments up until now. Even with those significant capital investments, we still delivered good return on capital employed. But this year, it's a pretty bare bones budget, about $1.1 billion, about $1 billion of that, as I said, for sustaining capital, about $100 million for infrastructure and delineation projects. Infrastructure, mostly two things. One is it's going to be a kind of an upgrade to our condensate stabilizer, and the other is going to be a little bit more water handling. Those are the things that have allowed us, that water handling has allowed us to bring those operating costs down as much as we have. I had showed a chart before. Our operating costs last year were $479 on the year. So down substantially from where they had been. A lot of that is because of the investment in water handling. So also we have projections here for all of the, I think the significant operations metrics in the year. So production, we still expect to average 200 to 205,000 BOE per day. That will be a little less in the first half, a little more in the second half. First half, 190 to 200,000 BOE per day. Second half, 205 to 215,000 BOE per day. We will have something in the range of 75 to 80 wells brought on stream in 2020. Our production of condensate will be 34 to 38%. Last year, fourth quarter was 37%, 36%. Full year was 37%. We expect to be about the same by the end of this year. In the beginning of this year, we're having more contribution from our Nest 3 area, which is a bit leaner, and that's part of why the condensate yield's a bit lower to begin the year. But at the end of the year, and on average for the year, we should be back right in the same range that we've been for the last several years. I think, and I'll get to it in a slide or two, I think it's really important to note that year after year, we've actually produced more condensate than we had expected. So that's been a big contributor to our revenues. And just a final couple of things here on what's on this chart. So we've got operating cost expectations of $475 to $525 in the year, and G&A still 85 to 95 cents. So we're looking at, I think, some free cash flow even with today's WTI. Lots of free cash flow if WTI recovers from here. A little bit of detail on our land position. I had mentioned earlier that we have about 800 sections, about 550,000 net acres of Montney rights. This shows how we've divided all this up. The green area is in total the nest. Our focus over the first, I would say from 2014 all the way through most of 2017 was on Nest 2 only. It's an area that we know the best. We, in fact, in 2017 and 18, worked extremely hard to understand the reservoir even more and recognized some areas had a little more condensate, some areas had a little more gas. We really did all the science that was necessary to help us to predict better than ever what we were going to get from each new well. And I would say, I want to emphasize, over the last 2 years, we've delivered the operations metrics exactly as we had committed with our original guidance for both 18 and 19. And so that's important to us. That comes from this fundamental science that we've done. Recently, last year, we dedicated quite a bit of capital to delineating our nest further, and we were able to push the boundaries, actually, of our Nest 2 by more than 100 locations. Last year, we drilled 79 locations, so we've actually added more to the Nest 2 than we drilled, which I think is pretty important in terms of that sustainable entity that I was talking about. You've got to replenish the hopper so you can keep drilling these excellent wells. I mean, think about it as a widget factory. The inputs, building the widgets more and more efficiently, getting good prices for it by accessing markets, that's all important, I think, to sustainability. We also, you can see in the bottom part of that nest, the Nest 3 area, that's relatively new for us. We had drilled a couple of wells there in 2018, found it to be more prolific than expected. We decided to focus on it last year. So we drilled quite a number of wells there last year, just about 20, and we put a big pipeline in to connect the Nest 3 to the Nest 2 area. So that is contributing significantly now too. That pipeline that we built will allow us to take about 40,000 BOE per day from the Nest 3. Also shown on this map are the gas processing plants that we have built, as well as one that we have access to that the third party owns. But we've built our own processing plants, 3 of them, each with about 250 million cubic feet per day of processing capacity. We're a company that produces about 500 million cubic feet per day, so that we have more than enough processing capacity for our needs for several years. In fact, we were looking for ways that we maybe can augment our revenue stream by more fully utilizing those plants. I also want to touch on the fact that our Nest 3 area, we've been doing quite a bit of lower Montney work. Our Nest 3 area, one of the lower Montney wells below the Nest 3 is actually our very best lower Montney. So the lower Montney, the best of the lower Montney doesn't happen to coincide with the best of the upper. So I think that's a pretty important point to make. And our Nest 3 area lower Montney work has actually been very rewarding. This chart is showing our 2019 reserves bookings. The top left chart is showing the improvements in future development capital through time. Our year-end 2019 future development capital was $940 million, about $3 per share less than the year-end 2018 future development capital. So a very significant improvement in, well, it shows the capital efficiency improvements that we've been making. So that contributed significantly to the fact that even with a lower commodity price, we ended up with more value, more than $12.6 billion of net asset value attributed to these 2P reserves, according to the independent evaluator. That was augmented as well, and included in that number is the fact that we have more condensate than we previously had expected. On the number to the right there, the 1.6 billion barrels, that's our 2P reserves, 1.6 billion barrels reserves on a 2P basis. That is, if you take that 1.6 billion by today's production, it's around 22 years of reserve life index. And I'm going to talk about it in a slide coming up, but I think it's important to note that the 2P reserves only include about 3/4 of our upper Montney in the Nest. It's 966 locations, whereas we see 1,316 upper Montney locations in the Nest. So you could consider that 22 years of reserve life index, if you actually gave full value to all of the upper Montney, is more like 30. And that doesn't include the lower Montney, really, and it doesn't include any of the Cretaceous. It doesn't include any of the Wapiti. We have decades and decades of inventory, including about 20 years of top-tier inventory. I think there's an important ratio there showing the 1.6 times the PDP recycle ratio. The 2P recycle ratio is about 2.4 times. The 1P recycle ratio is about 2.6 times. So I think excellent recycle ratios when you compare them to any other company. And the two circles on the right side, that's showing what I was getting at earlier. The fact is, as we don't grow as rapidly as we used to, the average age of our wells increases, and therefore the average decline rate for the production, or decline rate for our company, goes down. And so that decline moderation is it's a significant contributor to the fact that I think we're going to have one of the biggest growths in free cash flow yield in the industry. This is a bit more detail, as I mentioned, regarding the wells. A little hard to read, but it's still important. And what we've attempted to do here is put economics both on a half cycle and a full cycle basis, and at $50 WTI. And so you can still see that on a full cycle basis, we predict on average our upper Montney and the Nest is going to have about a 43% rate of return, which is pretty good on a full cycle basis. On a half cycle basis, of course, it's about 100% rate of return. But these are good economics. On the bottom, you can see our total location count. I'm going to show the undeveloped, the 2P part. That totals up, as I had said earlier, 966 2P locations. On the contingent side, even though these upper Montney wells we know are prolific, there's rules around reserve bookings, the NI 51-101 standards, that only allow about 3/4 of our upper Montney to be booked as 2P. We see another 350 contingent, therefore a total of 1,316 upper Montney locations in the Nest. And then over to the right side of that, you can see that we're getting a little bit of credit for the lower Montney, only 6 wells in the 2P, about 250 in the 2C, so over 250 wells in the lower Montney. And there's other opportunities as well. So on the circle on the right, you can just see the totals of the wells that we have. And so we've drilled about 500 wells so far. We've got at least 1,300 wells left in the upper Montney in the Nest, about 250 wells in the lower Montney, more than 160 in the contingent in the Wapiti region, and more in the rich gas areas and more in the Cretaceous areas. Like I said, I think we've got 2 decades of top-tier inventory, probably several decades beyond that of good inventory that we will learn more about through time. And that's about all I had for prepared remarks.
So the first question is more on the industry part. You mentioned, you are showing a lot of capital discipline. You have transitioned from a volume growth story to a free cash flow story. Out there in the industry, when you see out there in the condensate side, do you think the industry as such is showing a little more discipline, or do you think there are players out there who are still trying to grow volumes at pace, which can cause problems for the industry as a whole, pricing-wise?
Well, it's a great question. I think I'm probably only qualified to speak to what we're doing. And it's been important to us. I mean, we're blessed with several things. One is we have a great asset, which is very liquids rich. It does have all the condensate that you talked about. We've also, I think, improved our discipline around how we execute. That's allowed us then to focus on free cash flow generation. And because, I mean, even with a fairly high decline rate, which is coming down year by year, but because the quality of the asset is so good, we have been able to generate some free cash flow. So for our company, which is probably all I should speak to, I think our outlook is really strong. We've got a very big inventory. I mean, as I said earlier, feeding that hopper, the hopper that feeds this widget factory. We've been getting better and better at how we construct these widgets, whether it's drilling wells or completing wells or building facilities and so on. And we're getting good prices, particularly for the condensate. The condensate demand outlook is, I think, very, very strong, and the supply outlook is flat, I think. So condensate demand is likely growing a little bit. Supply is staying flat, if not shrinking a little bit. So I think there's a great expectation for us to continue to enhance that free cash flow yield. So I danced around your question. I'm sorry, Manav, but I probably can't speak to other companies' strategies.
With the recent coming in of some crude prices, have you seen any kind of slowdown in oil sands activity where your top buyer or somebody has come in and said, we probably will scale back some operations in the first half, or you haven't seen that yet?
We haven't seen that yet. And of course, I mean, the investment cycles for oil sands are long. And so the operators and the owners of the oil sands assets make decisions that will generate returns 20, 30 years in the future. Obviously, we saw Teck withdraw their application for their project. That was something that wasn't going to affect supply of oil sands or demand for condensate for many, many years, even when they do proceed. But no, I think our expectation is that demand is increasing right now. We're seeing Fort Hills ramped up a little bit. We saw a conversion from synthetic crude or light oil as a diluent to condensate instead. So that meant condensate demand was going up. And I even think that some of the diluent recovery units, some of the rail solutions, they're likely to result in increasing demand for condensate. I think that's something that's poorly understood. The likelihood is that pipes continue to be filled, and of course, all the existing pipes are full, taking around 30 or more % condensate with them. And there's, I think, expectations. I believe Trans Mountain expansion is going to happen. I believe that Enbridge, they've already finished building their Line 3 on the Canadian side. They probably will build it on the U.S. side. And Keystone is likely going into the ground as well. All those things mean pipeline solutions that will facilitate or enable growth in oil sands production, and therefore will result in an increasing demand for condensate. And even the DRUs, I think, as I said, the likelihood is a pipe stays full. The DRUs, even though they'll be sending out a neat bit by rail as opposed to a dill bit, they'll still need a bit of condensate. And so I think, in my opinion, even a DRU generates incremental demand for condensate. So we're now seeing a couple dollars premium for condensate above WTI, and the outlook is, I think, very favorable for us. So we're very pleased to be the biggest condensate producer in Canada.
Do you see more industry consolidation at this point within Canada?
I think that's likely. When it happens, I'm not too sure. I mean, the reality is that we all have opportunities, I think, to get a little more efficient if we can achieve some scale. The reality is that consolidation doesn't generally happen in lows. And so I think people have to get some comfort around what is the stabilized value for the products that we produce, and what can we all do. As a company, we are involved in M&A right now. We're involved in an acquisition of one of the very best Montney assets in Canada. We're buying back our own stock. And so we think that's a very good allocation of capital, and we'll keep doing that. We have a great inventory of, I think, some of the very best assets in North America, some of the very best assets in the Montney. So we're happy with doing that. I think that's a good way to serve our shareholders. That is a consolidation of sorts. And in the future, I think there will be opportunities for us to participate in other consolidations. I think a company like ours who has free cash flow, who has a depth of inventory of high-quality assets, I think as long as we don't get consolidated first, I think we're probably the natural consolidator of assets in the future. So we're always looking to it. We have a team dedicated to looking at mergers of equals or M&A opportunities. That we just added a new, very strong person to our team. She joined just Monday this week. She's our Director of Business Development. she'll be very focused on that M&A strategy and also looking for opportunities.
You have lowered CapEx to 1.1. As you look out at 22, 23, 24, what kind of sustaining CapEx is needed to keep the production flat at current levels?
Yeah, a great question, and I think, so the question was what kind of sustaining capital is needed to keep us flat at 2022, 2023 timeframe. You know, we've been seeing it for the last 3 years step down by about $100 million per year, the sustaining capital level, so about 10% per year. I think it's conceivable out there at that time, just 2 or 3 years from now, that sustaining capital is $800 million a year. So that will go down, and I think since most of our major investments have already taken place in plants and pipe, we can get very, very close to sustaining capital as our total budget. You know, the reality is even this year, I mean, we're going to do all we need to do to protect our balance sheet, and the reality is that everything we do, you know, other than what we've already invested in January and February, our whole 2020 program is discretionary, and we can peel back capital if we want to. And I think that, you know, if commodity prices stay where they are now, other peers won't be as active as they might have thought they would be with their original budgets, and that should mean costs get even better for us, and therefore we can probably get more done for less money, or get the same program done for less money. So by 2022, I think we're going to have $800 million-ish of sustaining capital. If cash flow continues to be what it was last year, we could be looking at $600 million of free cash flow. Therefore, we could be looking at $2 per share of free cash flow.
We assume a majority of that would be allocated to buybacks.
You know, it's something we'll monitor. We do monitor on a regular basis. We've on a monthly basis, we're updating our capital allocation views and thinking about, you know, our strategy for the future. There's a lot of factors. I mean, in what the best capital allocation will be. It'll be commodity prices. It'll be what's our share price. What are the other opportunities? You know, in that time frame, perhaps we're thinking about mergers. In that time frame, we could be thinking about a dividend. I mean, all these things are capital allocation choices for us to work on and recommend to our board and come up with what we think is best for our shareholders and all stakeholders.
Last question for me. You recently upgraded some wells, about 100 wells from Wapiti to Lower Montney. You moved the type curve up. So what drove that decision to move the wells from Wapiti to Lower Montney in the S2 area?
Yeah, so it was actually in the Upper Montney, in fact. So it was the Upper Montney and what we used to think as more of a Wapiti area. We moved those Wapiti, what were previously thought to be Wapiti wells, into the S2. The cutoff tends to be liquids yields and also whether or not they're sour. And so what we found is as we pushed our limits of our S2 towards the Wapiti area, we found very good productivity with lots of liquids and still sweet. And so that's what made it designate to an S2 type curve. So, but again, that is just the upper, but it does probably expand the opportunity in the Lower Montney as well. So it's, you know, something we've been able to do as we've gotten to a stronger company with free cash flow. We've been able to invest in some delineation work of the lower, as well as now pushing out the edges of Nest 2. We did a bit of that in Nest 1, a bit in Nest 3. All those things, as I have probably said too many times, are going to allow us to replenish that hopper of drilling inventory to maintain our ability to be a sustainable company.
I think we're good, sir. Thank you.